All right, I'm going to start the webinar. And we're going to give it just one more minute and let some folks enter the room to see the attendees climbing. So we have a lot of people interested in this topic. All right, let's go ahead and kick it off. Hello, everybody. Welcome. I'm Bridget Howard, and I'm the Senior Director of Marketing at Consero Global, and we provide finance as a service to middle market high growth companies. We take care of the back office, finance and accounting, and we quickly give our clients an optimized finance function in as little as 30 days. And we do that with our skilled finance team and our pre-integrated software stack. So today's roundtable discussion is focused on add-on acquisition readiness, and your host and panel moderator is Chris Hartenstein. And Chris has a great deal of experience with acquisitions. Just last year, he helped our clients successfully and rapidly integrate a total of 18 acquisitions. So he is certainly the person to lead this discussion for us. I'll be back at the end to take your questions, but during the event, please feel free to put your questions in the Q&A and we will answer them at the end. Also, for all of our attendees, we will be sending you a recording of the roundtable as well. So enjoy. Chris, I'll pass it on to you.
All right, thanks, Bridget. Again, my name is Chris Hartenstein. I'm the Managing Director and the VP of Customer Success at Consero, and have been here for 7.5 years and have worked with a couple of the people on this panel today. And again, we've really been focusing on PE firms and their acquisition plans and things like that, and we've got people that can talk to that today. We've got a great panel. I'll let them introduce themselves, and Scottie, I'll go ahead and start with you.
Sure. Hi, thanks, Chris, and thanks, Bridget, for organizing this. I'm Scottie Wardell. I'm one of the managing partners and co-founders of Integrity Growth Partners. We are a growth private equity firm based in Los Angeles, and we focus on lower middle market software and tech-enabled services businesses, and we also work closely with Consero. Glad to be here.
All right, Steve.
Yeah, absolutely. My name is Steve Isom. I'm the CFO of a company called Bloomerang, cloud-based donor management and fundraising system for small to mid-sized nonprofits. I started with the company at the beginning of this year, but prior to that, I was at a company called Flywheel, which was a managed WordPress hosting company, and implemented Consero in 2018 and worked with them through the sale of Flywheel in 2019 and kept the Consero team on board for another year into 2020.
All right, thanks, Steve. Trey.
Hi, I'm Trey Chambers. I'm with Idera Inc. And Idera delivers business-to-business software productivity tools for IT teams and R&D teams. We've got 3 business units that have been created over the years: database tools that focuses on database modeling, monitoring, and administrator tools; developer tools that help developers create applications; and then DevOps tools that help streamline R&D development processes. We're PE owned. We've got 3 major PEs in our ownership structure, and ownership structure kind of keeps changing. We've done some dividend recaps over the last few years. TA Associates, HGGC, and the Partners Group. The Partners Group is now the majority owner in Idera. We're basically an M&A platform also. We've completed 17 acquisitions in the last 4.5 years, all shapes, sizes, and valuations. So this topic's obviously very keen to myself and my team. We're located all over the world, but we're kind of Texas based, and we've got offices in Houston and Austin that are relatively about the same size.
All right, thanks everyone. Again, I think we've got a great panel and are looking forward to some good discussions today. And we'll start by kicking it off with looking at what are some of the key priorities that companies should be looking at when they're negotiating and trying to close some of these add-on acquisitions. Sometimes we can see those things be challenging, but Trey, you guys have done a bunch of them and are really good at getting the negotiation done and getting these things closed. Would you like to start with some comments about what you guys look for when negotiating, closing these deals?
Yeah, sure. And, we haven't always been good at it, and we're always learning and trying to get better. But we have certainly done a lot of them. The key, I think, for all M&A and just where it all starts is, to find a good target. I mean, I know that goes without saying, but know what you're looking for. We have an M&A team in-house. They're looking at pipeline of our M&A candidates and who's in our space and always talking and creating those relationships, because a lot of our acquisitions are not people that have said, hey, we're for sale and have come through different pipelines. They're actually people that we've talked to and said, hey, we're interested in buying you all. And then we end up, getting a deal out of it. So having a really robust pipeline and keeping those conversations going to understand what you're looking for, whether or not it's a strategic fit, for the technology that you may be missing. Maybe it's a superior technology to what you already have and what we already have. We're like, these guys are a little better at it, so let's figure that out. Or maybe we're just removing a competitive threat. All of those things aren't matter. And some of the acquisitions that we do are growth oriented, and some are, they have recurring revenue with a very nice revenue base, maybe a little older technology, but have a big synergy opportunity. And so we can get a whole lot of profit. So we actually like a really good mix out of those. So that's kind of step one and kind of how we think about things and where we're targeted. And then once we have a target, then we'll go put together what we call kind of a quick, what we call a skinny model, kind of upfront model. It uses we'll get financial information from the target at a high level, try to understand enough about it with some high level questions that we'll go to the target with, so that we can then say, okay, what do we think, without doing a whole bunch of diligence, what do we think this would look like? And then we'll come up with a purchase price, either based on revenue multiples or EBITDA multiples, that then we can pressure test, as we go into diligence. As a team, before you're ready before you get going, you need to make sure you're ready to get going. Know who's going to help you on your quality of earnings report. Do you need a quality of earnings report? Every one of the acquisitions we do, we actually hired Deloitte to help us with that. And basically, for those of you who don't know what a quality of earnings report is, it takes, the historical financials, and they're doing a little mini audit. They're not doing any kind of, GAAP financial statement audit, but they're making sure that if there's any lumpiness, any one-time things, any things that they put, that a company will put below the line. Should it really be below line, or is it really more operating in nature? Those kind of things. And that'll help smooth out their earnings so that we kind of know what history looks like. So anyway, know what you're going to do there. Have that kind of ready to go. Know who from your own groups. We know who from our own groups are going to handle the diligence in each department. We have a diligence tracker, and after all these years in doing these things, we didn't really have a great tracker at the beginning. We've created a great tracker now. It goes from everything from cash management to how we're going to do the GL to what we're going to look at in diligence, what we're going to focus on, how we're going to pressure test the revenues, things of that nature, and then we assign owners, and then we track that. Our goal is to get deals done in 60 days. Generally turns out to be about 90 days, still pretty quick. The goal is really to fish or cut bait, quickly. So we want to get to the high risk areas first and know what those high risk areas, and, in our business, obviously that's going to be, are the bookings real? Are the revenue real? And is the growth real? And sometimes the growth could be spurred on by a price increase that just happened last year. And so you got to dig into that and say, hey, is that recurring, or is that, kind of a one-time growth, and maybe that growth won't recur. So those are the kind of things that we focus on and try to focus on early. So if we decide we don't like what we're seeing, we can move on.
And then we walk away from that pretty quick, right?
Yeah, because the goal is to walk away quickly, so you make decisions quickly, because you just keep stringing these things out and then walk away, and then realize you got a problem at the end. You've wasted a lot of time and money and time on the seller side. And then we include a lot of our team on all the calls as we learn about the company. I do that on purpose, and I didn't always do that. It used to be a small team that was kind of involved, so we keep running our day-to-day business. But then when the deal would close, we weren't ready for the integration. We'd have to have the same conversations over and over again with the target to say, hey, explain the business here, because now I need my revenue person to understand it, or I need my controller to understand it, or whatever the case may be. And in order to speed up integration, have everybody knowledgeable, have everybody join those calls to learn about it, so that we can hit the ground running. We try to not let everybody ask a bunch of questions. We funnel the questions through a single source, so we're not overwhelming the seller, but it really works well. So as soon as we're getting close to closing, everybody kind of has their integration plan ready to go and understands where some of the gotchas are.
Right. Those are, all great points with, like I said, making decisions early and keeping the process moving and things like that. Those are all very important. So Scottie, what do you guys look for in negotiating and closing those deals? What are you guys' hot buttons?
Really nice job touching on, a lot of the major points, but I would definitely start, I think, at the same place that he did, where, making sure you've got a really sound rationale and thesis for whatever you're doing. I think it can be very attractive sometimes to just say, hey, maybe I can get this at a really cheap multiple, or maybe I can, just slap on this. I hear I get a bigger multiple if I get myself to 15 million of ARR or 20 million of ARR. And, there's definitely benefits, to scale, and M&A can be a way to get there quickly. But at the same time, people are always, whether it's on an exit or something like that, they're going to unpack sort of where things came from. And, if you don't have a strong strategic rationale, and if you don't sort of take that time to make sure this is really something that fits in with the thesis and the story of the business that you're building holistically, you're not going to get that credit just because you happen to have added, some additional dollars to your P&L. And in fact, you may end up detracting from your ability to pursue organic opportunities and other things that you're working on if you kind of stay overly focused just on what things look like on paper. And so I would just sort of re-underscore what Trey said there, and really making sure that it makes sense for the overall business thesis that you're building, and that you're not sort of just trying to achieve scale, or just trying to get to some certain numerical value, or are just sort of overly attracted to a certain valuation. So I think that that to me is a huge part of the battle. And then from there, it's also really, I won't repeat what Trey said, because again, I think he walked through a really nice subset of things. The one thing I would add that he didn't touch on as much is also thinking structurally, what does it take to actually finance these acquisitions? If you are going to be incurring debt, is that going to place, burdens on the business that are going to hinder other types of growth? Are you suddenly going to have profitability covenants that you need to be accountable for? Are you suddenly going to be taking cash flow away for amortization that perhaps could be spent investing in other areas? So I think from a structuring perspective, being really cognizant of your sort of source of the capital that you're going to be using to finance these acquisitions, especially just speaking for myself, where I focus more on that lower middle market, where our businesses tend to be at very critical organic inflection points in terms of their growth. In addition to pursuing these M&A strategies, we really need to be sure that taking on M&A and taking on potentially some of the kinds of financing you need to facilitate that are not actually hindering some of your more important priorities on the other side. So I would say, source of the capital is the one, kind of key area I would add on, in addition to what Trey said, that you just need to be really cognizant that the holistic business picture makes sense to you. But otherwise, I think you did a really nice job walking through.
Yeah. Again, like I said, I like the piece of the business has to fit. It can't just be something to add on to try to add multiples and things like that. I think that's a great point there. Steve, anything you'd like to add as far as getting ready for these deals and negotiating these deals? You've been on the other side, on the acquiring side recently, so would like to hear what you have to say about that as well.
Yeah, absolutely. So I think one of the things to keep in mind is that with most of these deals, by the time you get into diligence, it's really confirmatory diligence, right? Like there's an investment thesis, there's, whether it's in term sheet or LOI, right? And really, especially the role of finance is to continue to give them confidence. So thinking about every interaction that you have with the potential acquirers as an opportunity to build their confidence in your business, and showing that you have a real good handle on the business, erring on the side of transparency, talking about where that company is maybe in your internal roadmap around controls, policies, forecasting, and kind of tell the story of where you were, where you are today, and where you are planning to go. I think you develop a really good relationship with the acquirer, and then you find yourself in an unfortunate situation where, hey, maybe a number you shared was incorrect, or you have additional detail that you pulled, you've kind of built that rapport and trust with the acquirer where you can have a really transparent, open conversation around it, as opposed to, trying to sneak by some adjustments in the data room, right, around an updated.
Again, I think that good points there too. And I think when we're doing these transactions, there are a lot of things that you really need to understand and to make the deal work. And a lot of that comes from the finance function. And I'm sure with some of the companies that you've looked at and seen before, when the finance department really isn't in order, or there may be some things that are problems, it can kind of stall the deal. But what kind of red flags do you guys see in the finance function that makes you be a little hesitant? And what things have you done in your finance department to alleviate some of those things in the transaction process? And Steve, I'll kick that back to you again from just being on that acquirer side. How that helped you guys gain some confidence and some trust in the overall deal.
Yeah, absolutely. So I think that there's this idea of readiness, like deal readiness. So, there's a difference between getting an unsolicited inbound offer and going into exclusivity, or hiring a banker and having 60 days to prep.
Put together the data room, right?
Yeah, that unsolicited inbound is always a possibility. So I think I've always made it a point to have information readily available in a structured format, so that, whether it's hey, we decided we're going to do debt financing, or, we got an unsolicited inbound, or trying to anticipate those questions, maybe even just from your own board, being ready for that. And then I think that, when you're on the acquirer side, is you're really just looking for an efficient operation, right? You want to make sure that, while product and engineering leaders may be worried about inheriting technical debt, as a finance leader, I think you really need to look for, am I inheriting operational debt? And are there things that are really broken in the processes today? And I think, Trey is will probably speak to this as well, but it also there's a lot of value in getting your team in early and, ripping the Band-Aid off on starting to integrate, especially the finance and accounting functions.
Right. So Scottie, what kind of flags do you see when you guys are looking at deals?
Sure. So I'll step back and do it a little bit more from a qualitative perspective. So, one thing that's an obvious red flag, if the numbers keep changing, if you're seeing, things that are coming from different systems that say totally different things, which may have a very logical explanation, that just maybe where the maturity of the finance function is for that business, especially depending on where they are. So it doesn't necessarily mean something nefarious is going on, but it does mean that, hey, you need to be prepared that there's going to be a little more noise, in the quality of these earnings, as Trey was referring to before. So inconsistency is a really simple one. If you're seeing different things in different places is always something to take a closer look at. And a lot of it, to me, that I'll speak to is in the presentation of the information as well. So, when I'm looking at how confidently are the different members of the management team speaking to the numbers, how much command do they think they seem to have over their metrics and what's going on and what the key drivers are. Do they come across as transparent? Are they giving me explanation, or do they seem to sort of bristle if I'm trying to get to the next layer of questions? And some of that can also come from the body language that you're observing between the different parties, whether it's oftentimes sort of the CFO and the CEO, and, seeing is there sort of cringing from one or the other, depending on certain answers that are being given that may or may not be fully accurate. Are you seeing sort of tension? Are they kind of, cutting each other off a little bit? Those things can be red flags, just giving you signals that there's perhaps, a lack of coordination on the other side of the table, or that there's, differences in opinion in terms of explaining the drivers of what's happening or what we're looking at. So those are the things that I would say when I'm truly seeing a red flag, it's most often coming in that way. A truly sort of technical red flag often will come out too in the detailed accounting review if you're not able to reconcile cash against, because cash is the one place where there's sorry.
Right.
Awesome.
Somebody rang the doorbell.
knew we had to have that happen once in our thing. But if you're not able to reconcile cash at the end of the day, then that's going to be something that gives you an obvious answer that there is an issue, that they're potentially hiding something as far as the potentials that you need to look at. Getting that good quality of earnings and a good quality of earnings provider is key.
Right. But I like kind of one of the points too there, body language in the meetings and how people are interacting with each other and with you. I think, that's huge from a customer success standpoint. When we're doing work with clients, looking at that body language and, again, trying to make sure that we feel like people are being transparent with the discussions and things that we're having. I think that's a huge piece of it. So, Trey, you want to talk a little bit about what you guys look at and what red flags and things you guys see when you're doing your deals?
Yeah, sure. I mean, Scottie and Steve hit on most of the good points, and Scottie's dog starts barking. I'm surprised my dogs haven't started barking too. But the quality of earnings report, the diligence that you do. I mean, you're going to find out where the issues are, obviously. But to Scottie's point, whenever you get the data, is it easy to get to? When you ask a question, were they able to give it to you pretty quickly, or did it take them a number of days? Are there systems and processes working well? I mean, what do they push back on? What are the sellers pushing back on in terms of the questions that you ask? And sometimes those pushbacks are legit, because you're getting too far in the weeds. But a lot of times you're like, wait a minute, that's pretty basic stuff. And if they don't have that, then you got to decide, is it okay? Is it okay to move forward? And we'll just have to figure that out post close. And could that be a deal killer? And we need to delay the deal. All of those things are part of what I call the red flags, in terms of, well, what do we want to do? And you just got to have your priorities in terms of what's really important in terms of when you're going through diligence. We have found, certainly, this obviously is pretty obvious, but acquiring small and unsophisticated is way harder than acquiring large and sophisticated. It's because in terms of just the integration, the accounting, a lot of companies are just cash based in nature. They're just not as mature on a lot of the process and accounting front, which really means that you've got to pick up the pieces post close, and you may want to close over it, or you just may, I've always told my team, get everything you can pre-close, because you'll lose their focus, especially if this is a synergy play in terms of we're not keeping all the people. This is when they're most motivated to give you the data. So make sure you have your list of what you really need to have, because you may not get it post-close. So those are things that we watch for over and above just more of the higher level stuff that Scottie talked about.
Yeah, I think that's a good point. The smaller deals seem to take as much time as some of the bigger deals, and sometimes even more, based on the sophistication levels and what you're going to have to change from a thinking standpoint if there are no systems or processes in place with things like that. Sometimes makes it even harder to do that. So I know, in getting ready for a deal from a finance perspective, what are the top priorities the finance department should have on either side of a deal of an acquisition? Steve, what do you kind of see from an acquired, being an acquired standpoint? And then, Trey, we can talk about some of the ones on yours too. But Steve, if you'd like to go first on, how do you make sure you're ready to jump in the water in one of these deals?
Well, I think that most of the time people underestimate how much work it is to integrate a business. I think not everyone, I think Trey, you and Chris have done enough of these that I think you understand it. But that first or second one, just take any of the pain points in your business today and amplify them, right? Like you're going to be pushed on the areas of where your finance function is maybe not efficient. It's just going to be exacerbated with an acquisition. But I think that, continue to believe that integrating, getting your team in there sooner rather than later is really worth it. Especially, hey, maybe the business you're acquiring has a decently functioning team, or they've outsourced it, right? Like there's kind of this natural tendency just to think like, maybe I'll just leave it alone for a little while. But to Trey's point earlier, like you're going to have that time and attention from folks like pre-closing and then maybe a little bit post-closing. And then I think there's going to be kind of this precipitous drop off in willingness to kind of work with you on like, here's how we've done it. Well, why do we need to change it? So I just think like the more you can do up front and then right at closing, the better.
Right. Trey, you want to talk a little bit about that? I know you've spoken before about, rip the Band-Aid off and let's get moving. You want to address some of that?
Sure. Yeah, I mean, one of our CEO's favorite, statements is get to the future. Don't wait on it. Just get to it. It's scary. The future is always scary. It's unknown. You don't know exactly how it's going to go, but if you know you got to get there, just get there. So we want to use our processes and our playbook 90% of the time, or maybe even more, and the seller's always going to fight you on it. Everybody thinks the way they do it, including
Every
that's why
time.
we use our processes. We think the way we do it's the best way, right? And so the seller always thinks that. And at the end of the day, you want to pick the best processes. And if the seller's processes are better, great. Learn that quickly, make that decision, and then get on with it. Bumps in the road are going to happen. They always do. We make mistakes. Things are not going to be perfect. But the longer you take to get there, the more disruptive it is to your current business and to the acquirer's business, right? So, I mean, to the acquisitions business. So just get there, get going. And I've learned this from personal experience. And back, I'm aging myself now, but back in 1999, we were acquired by Motorola Semiconductor. I was with a small software company. And it was Motorola Semiconductor, which is now then turned into Freescale Semiconductor, and now was acquired by NXP. But that was Motorola's first acquisition ever, and they didn't really know how to do it either. And certainly it was the first time I'd been a part of an acquisition. And so they were very scared because they were a semiconductor company and we were a software company. They didn't want to mess up our culture. And we kept telling them, you're going to mess up our culture. We don't want to be a big part of the big behemoth Motorola. Keep us alone. We're better served just doing how we do it. And we spent almost a year probably figuring out and somewhat fighting over how to integrate, not integrate, don't touch us. And we spent so much time doing that. Hindsight, even when I was there, hindsight 2020, and now certainly it was just, we should have just integrated, got on with it and moved down the road and got to the strategic reasons for the acquisition and not worried so much about how things, were going to change. And if we lost a few people along the way that, because they didn't like it, well, so be it. That's just kind of part of what happens in M&A. So we just learned, like, just get it going and get it integrated. The other thing I'll tell you is have a staffing plan. Be ready, understand that the people that you're acquiring, understand what your staff looks like, and then have a pretty good idea about what position that you need to keep. You may not be able to meet everybody. Most sellers don't want to tell everybody in the company that they're selling the company. And even in the finance, we just acquired a company, closed on it last week. Only the CEO and CFO did all the work. It took about 4 months to get the deal done because only 2 people did all the work. But but they kept it real tight. But we knew kind of based on the positions, this is pretty much who we're going to keep or not keep. And so now we're just vetting through that and making sure that we were ready to be able to take on that business with the staff that we had, or if not, what positions do we need? And it's not all, obviously when you acquire someone, you're not always going to be able to keep their staff. Even if you want them, they may not want to be a part of that. Maybe they were a controller in the existing company and you want them to run something else, but they're not going to be controller. It may not be the role they want. So you got to plan on turnover also and making sure you got a backup plan there because you just don't want to lose any momentum. And then the last thing we do is we do these weekly integration meetings with my staff, and we actually start those, and we do it for each acquisition. We have a separate meeting for each acquisition if we have multiple going on at the same time. And we'll start those 2 or 3 weeks before the acquisition closes. When we know the acquisition looks really likely it's going to close, we'll start that within my own team and then start building to when so we're ready that when it closes, we know exactly what we need to go get, what didn't show up in diligence, et cetera. And then 3 or 4 weeks after the close, maybe even faster, we'll invite staff from the target to those meetings because we're all on the same team now. So Let's figure out how we're going to do these things together. And that way it's not just, where we're just mandating what we need to get. I mean, everybody's in it together. So, and that's really worked well for us. And that's something we've learned as we've gone through these.
Right. Scottie, what do you see as the value of the finance function on, either side of the deals that you guys are involved with as well?
I think I won't repeat, some of the tactical stuff that has already been touched on. I think, that was very nicely covered, but certainly serving as that, quarterback type hub in a lot of the, integration work and the analysis, and making sure you've got a lot of the blocking and tackling set up as you think about moving forward into the integration. Certainly having, finance in that quarterback type role is pretty typical. I think the one thing that I would add that we haven't necessarily touched on in full yet, although Trey, you were, I think, alluding to this in slightly different language, but I think really thinking about the change management, opportunity and function around any of these processes, just recognizing at the end of the day, and again, Trey, you were hitting on this well, that it's a lot of people coming together to get something done in a different way than they're used to doing it before. If you don't acknowledge that there's going to be different sort of psychological energy that's going to come to the table from both the acquirer and the target post-close, and again, that can look differently depending on how much staff you're keeping and what's going on. But the more that you can be thoughtful about that piece too, and finance, I think, can definitely play a key role in that. But being methodical about how are you making sure, the cultures are starting to integrate? How can you make sure that people are given opportunities to see how their goals are aligned, that they're thinking about the same things, that we're all marching in the same direction, that there's transparency, that people don't feel like there's sort of hidden information. And that can be tough because, as Trey said, sometimes there is hidden information, and some people get sort of surprised by an announcement and aren't necessarily involved every step in that. And that's okay. That has to happen sometimes. But I think being very thoughtful about what does that change management process look like, and how do you make sure you're really factoring in the individual people and their sort of personal, fears, concerns, or, to the positive side, excitement. And are there ways you can optimize everybody, who's involved on both sides of the table to make sure you've got the best talent outcome on the other side of what you're doing? I think that's really, really important because there's just so many, big and small elements that can get very unnecessarily, in my opinion, damaged if you're not paying attention to that human change management element. So that's the one thing I would add to augment what's been said, I think, really smartly and very well on the tactical side, is to really look at the fact that these are people that are needing to do these integration tasks at the end of the day, even if you're using, the fancy algorithmic methods or software to integrate, your data and get your systems in the same place. Getting your talent all marching in the same direction is going to make everything flow much faster, much easier, and be much more accretive to the overall goals of the M&A in the first place. So that's the biggest thing I would add to make sure that they're cognizant of that. And I think finance can play a key function in that effort.
Yeah, key component of that, again, human nature is to continue to want to do the same things, and we're a little resistant to change, and getting people on the same page as quickly as possible, and moving to the future, as Trey's talked about, I think are, really important things to be thinking about. And I do like the fact that, your finance team that, typically are leaders in the company for various reasons. And I think that's a great advice to make them, or ask them to, be a key component in that change management process.
Especially in a situation where you're looking to retain the majority of the folks of the company you acquired. I think that over communication, like just putting yourself in the other side's shoes and thinking like, okay, this is a huge change for them. There's a whole bunch of assumptions probably on the acquirer side of like, oh, these are really important people. We want to make sure that they stay, right? Like say those things and say them often.
Make sure they know that.
Yeah. And to Trey's point about ripping the Band-Aid off, I think that if you over-index towards like, we don't want to change anything, we don't want to rock the boat, what tends to happen is that any little change that trickles out over time feels so much more impactful, right? Because it's like, oh, there was no change at closing and they came in and they just said we wanted to work together. And then you're like, okay, we're going to change your payroll provider. And it's like, whoa, what? Like, right? Whereas if you kind of just, start rolling out some like basic administrative changes much earlier, it's not going to feel, there's not going to be this emotional response, I think, to what I know finance professionals would definitely just think is like no big deal.
Right.
Yeah,
that's a great point.
Chris, I'll chime in on that a little bit too. I mean, and many people in this call may have not been on either side of an acquisition, but people that are getting acquired by nature are scared, right? Because they are going to assume the worst generally, or they're going to assume that everything's going to change and everything's going to get screwed up. Even if I'm here, it's going to get all screwed up. And so the key, what we have learned from doing this is, instead of kind of just stringing everybody along, hoping we don't rock a boat, for a little while, is let people know where they stand the fastest you can. So we will meet with every person that we're acquiring across all functions, generally in the first week, and one-on-ones with the functional leader from our side, and tell them kind of that they're in one of three buckets. I mean, they're in a bucket that is, we know we're keeping you. We know we need your spot. We know we need your role. And so you have a long-term spot here. 2, hey, we don't need your role. I've already got a controller. I don't need another one. I'm sorry, it's just how it's going to go. But we need you for this long, and here's how this is going to work. And here's your severance at the end of this. We'd love for you to help us out through this period. Blah blah blah. And then the third bucket is, hey, we're not sure. We just don't know. We don't know enough about your role. We don't know enough about the company, so we're just not sure yet. But as soon as we know, we're going to let you know. And obviously, the not sure buckets are still going to be nervous, but the other people, people like certainty. And if you have certainty and the message is a good one, that's going to get everybody engaged a lot faster. Everyone swimming around and talking around the water cooler or around Zoom now, is not helpful to anything. So the more that I think you can approach everybody, tell them where they sit, make the decisions, and get on with it where you can. People appreciate that, even if it's not a good message. I have had lots of people going, hey, I appreciate you telling me early, so now I can get on with the next stage of my career. And it's generally very professional.
Yeah, you don't leave them in limbo that way. They've got a clear path and know what to expect from that. So, another thing that we wanted to talk about from a deal readiness standpoint, and Steve, I'll come back to you with that. I think you had said your deal was an unsolicited deal, and we talked about the transparency around that and being able to provide information quickly to the acquirers during the due diligence process. Can you talk a little bit more about some of the things that happened when Flywheel was being acquired?
Yeah, absolutely. So I think from the first meeting to closing was 30 days. So it was
incredible.
Yeah, it was really quick. So I think that we had been through an equity raise recently, so we had a lot of materials ready to go. And as a recovering investment banker, I'll have to say that having them presented nicely and consistently and good formatting, I think always lends more credibility to what you're presenting, right? And just, I'm not going to question, I'm less likely to question the reliability of this information if it comes over and looks more professional. And then really on the QofE side specifically, we really benefited from having Consero. So plug for Consero here. We got the QofE diligence request list from Deloitte, and because of Consero's process, and I know your question wasn't intended to be a commercial for Consero, but I'll take it as an opportunity. Is the team was able to turn around the full diligence request list from Deloitte in less than 24 hours. And that really kept the deal moving, right? It was kind of like, hey, no matter what, diligence, especially finance and accounting diligence, is not going to hold this deal up. And that was kind of it's like, we're going to make sure you get all the information you need. We're going to try to instill as much confidence in you as possible that we understand the business, and we're not going to hold up the deal. And then let legal be the log pull in the tent for the transaction. So I think that I could have used some of Consero's help on legal.
On some legal, I don't know if you want that. Again, I think that kind of hits a little bit on Scottie and Trey's points earlier too about the preparedness, and then, being consistent and transparent with the data and turning things around pretty quickly, and not having different systems giving you different information like that Scottie was talking about as being a red flag previously. So, what other things do you guys feel like from a finance function are really important in finalizing these deals and moving forward, and how do you bring them in and get them to scale with your current function? I guess Scottie, I know you guys are looking at multiple businesses in the same type fashion. What things do you look like from a M&A standpoint and consistency and things like that?
Sure, yeah, I mean, it always depends in terms of what we're looking for. It just depends on what the goals are of the specific company. Things we could be looking for are, does it, help to diversify our customer base? Is it some kind of complementary product offering? Is it, is it something that maybe is a common competitor we see, but that is smaller, and we think we can either enhance their product, or there's just much more synergy if we're no longer, competing against each other. Could be geographic expansion. So it's those different elements of really expanding whatever the core thesis or the opportunity of the business is. So those are the most common justifications for us. Also, just the benefits again of combined scale, that can improve the profitability of the pro forma entity. Although you need to be very careful, because synergies often don't play out in M&A quite the way you think they're going to on a piece of paper. So, that's something you got to be careful with, but getting to certain scale with integration. So those are some of the common themes that are going to be rationale for M&A for us in most instances, that it's going to, build upon the thesis that we've already made in the core business. So that's just from our perspective. Obviously, different types of private equity firms have different viewpoints when they're thinking about, in particular, how they think about M&A playing into their strategy. But for us, those are some of the highest level things that we're looking to achieve if we're going to undertake M&A.
Right. Trey, any comments that you guys look at as combinations and scaling and other things like that? I know I feel like you guys are really good about consolidating functions and business lines from what I've seen over the last couple of years.
Well, I'll put a plug in to Consero. Consero is great at onboarding new companies. I mean, that's what they do. Everybody that they generally moves to their platform and use their service, they're moving off of another platform. So for us, every acquisition that we do, we have to get those, they're not generally aren't using Intact or using the Consero stack. And so Consero does a great job of moving, those companies onto their platform, because that's what they do in their day-to-day life. And I don't know that we could have done all these acquisitions over the last few years. I know we couldn't have without Consero's help, because they're really good at that stuff. And it helped us kind of focus on the business. The other thing I'd tell you is, don't forget about the financial planning and analysis side. Have the model that I talked about, the skinny model kind of early on when you're kind of going through the LOI stage at the beginning, as you're going through and making an offer to the target. We refine that model as we go through the process and diligence to have a final model that, when we're ready to make the purchase, this is the final model. This is what history looks like based on the QofE. And then this is what the future looks like in terms of what we think the model looks like. And then we focus on that big time as we go forward. And for all these acquisitions, we actually keep them pretty much standalone for the first year. I mean, we'll integrate where it makes the most sense, but we'll try to keep somewhat standalone so we can measure the P&L on that versus the model for the first year. So we don't lose focus on how they're performing, what our plan was. A lot of times you integrate and kind of mix up the mixing bowl of stuff, and you're like, well, we don't really know kind of how that acquisition ended up. We really focus on that. So at least the first year, we have good visibility of that. So I'd say that those are two of the big things about how finance can add value post acquisition, and then having those KPIs, right? Based on what happened at diligence, based on what happened in history, where should we be focused to make sure that acquired business, not only just the integration, but the acquired business is functioning the way we want it to, and if there are some synergies in terms of what we're trying to do operationally, have we hit those, and did we do them as quickly as we said we would? And measuring all that's really, really important.
Right.
Yeah, I think Trey,
Go ahead,
you hit
Steve.
on something really important there. And I think especially in a dynamic where you have active investors and maybe the investment team took the lead on the initial financial case for the acquisition, you really need to make sure that as a, whether CFO, the FP&A team really understands it, right? And because you're the one owning that going forward. So the likely your investment partners, it's like, yeah, we remember putting that together, but I've, done 3 deals since then. So making sure you really own it. And then I think to Trey's point, like having defined success criteria of the transaction you're doing. Like we said that in the first year, these are the 10 metrics or milestones that we expect the acquired business to hit, and having some reporting cadence against those metrics. So that and I think your point, Trey, about keeping it standalone from a reporting standpoint makes a lot of sense. It's pretty much the only way you're going to be able to objectively kind of assess the success of the acquisition.
Yeah, the one thing I would add to, just from a tactical perspective, on, again, where the finance function in particular can add value is just thinking about, some of the things that Steve and Trey both highlighted. There's a lot of moving parts post-close and pre-close, but certainly post-close, and having, a defined and clear and transparent project management function around some of this stuff too, and having real visible accountability, whether you're using project management software like a Rike or an Asana or a Trello or something like that, but having systems in place, or at least a systematic approach, if you're not using a tech-enabled system, to be really clear about who is doing what, who's owning what. There's just a ton of pieces that can very, very easily get lost in the mix. And again, as much as it seems like a more simplistic part of the process, in my experience, it's part of what can really break down, the broader achievement of the goals if they're just, those foundational basics are not in place. And again, especially as you're integrating new teams, and it's very, very easy for the responsibility and the ownership of different pieces of the machine to get lost. So being very thoughtful about project management, I think, is really important too. And again, something where I think finance can take a really important role in leadership and ensuring that you've got that systematic approach in place so that you are achieving those milestones, like Steve said, that you've got a clear definition of success, that you understand who's, holding the ball for owning that next step to achieve those goals. Losing sight of that and getting, if you're not organized early and often, can really create, again, unnecessary value destruction that just didn't need to happen just because people are not clear about who's supposed to be doing what. So that strong foundational project management function, I think, is really key, and finance is great at leading that area.
Yeah, Scottie brings up a great point. And I talked about our weekly meetings that start a little bit before the acquisition closes and then post. Well, we assign a person, so we have this playbook now that we've developed over the years. And I'll tell you, we didn't have it at the beginning. And it was exactly how Scottie described it, in terms of, well, everybody's supposed to do something, but we weren't really following up. Was it really getting done? And, did the person really know how to do it, and et cetera, et cetera. So we just created this humongous spreadsheet that has now grown arms and legs, but in terms of kind of function by function with owners. And we have somebody that actually has a day job, but this is what their night job is to manage that tracker. And we, in the weekly meeting, we're going through that tracker to say, hey, this is what's supposed to happen in the first 30 days, in the first 60 days, in the first 90 days, and have these things happened. And then everybody's on that call kind of feeding into I did this, I didn't do this, or we need to look into this. And then each acquisition will have its own challenges and kind of one-off things, but it really helps keeping everybody accountable. And I'm on every one of those calls, not so much because I'm adding a whole lot of value to it all the time, but because it just makes everybody focus on it and keeps that integration engine working as we're still trying to get through our normal quarter ends and reporting and all the things we got to do, kind of like, just in your general job. This is kind of the adder, and it really has helped keep all that organized and people accountable.
Yeah, I think the piece to learn from that is, having action items for the people, and you guys have done a great job of assigning responsibilities and things to various people to make sure that they get done, to make sure things keep moving on. I see that with your team on a daily basis, working with those guys. Anything else? We're getting kind of close towards the end. Any of the three of you like to talk about any other potential subjects or anything you'd like to bring up?
The one thing I'd say, Chris, is that I think that project manager role post-deal integration is super important. But as a seller, making sure you have that role during the sale process as well. I think that inevitably during a standard sale, you're going to have to bring in other people into the process to answer diligence questions. And I think that that quarterback person needs to make sure that the context of the overall arching deal is kept in mind as those questions are answered, right? Like, you may get, the head of R&D, VP of product, CTO, whatever, here's a list of questions. They farm it out to members on their team, and they're just kind of answering the questions with no context of what's happening more broadly speaking. So what I always like to do is, it's what I always like to do is review all of that, making sure okay, is that consistent with kind of the story we're telling, and just viewing everything through the lens of the acquirer, as opposed to just oh, here are some questions that I got answered that I need to get answered.
Right. Yeah, I think that's really true. Like you said, just making sure somebody's looking out for the end goal with things like that, and not providing answers that may not. And again, it goes back to one of Scottie's earlier points. Is the message consistent between the different people in the company? Having that consistent message throughout is obviously builds trust, transparency, and everything else to be able to do a deal like that. Bridget, have there been any questions or anything that we'd want to look at in the last couple of minutes?
Yeah, so a couple of people sent me questions through the email invite, but we did have one question come through the Q&A. Can we touch on considerations in regard to equity versus asset sale from the acquiree perspective?
Yeah, I could talk a little bit about that because it's really a tax question as much as anything else. I mean, an asset sale is always in the benefit of the buyer and not in the benefit of the seller, because the seller is going to be double taxed on that. If the corporation is going to be taxed on the profit, and then if they distribute it to their owners, then the owners are going to get it. So a stock sale is always what a seller is going to want if they're selling all or majority of their business. It's always, but a buyer always wants it because hey, all the liabilities stay in the old entity, and all you're doing is buying the assets, and you only have the liabilities on a go forward basis and not anything from the past. So that's always a negotiation point. It's hard to win as a buyer, if you're buying the whole thing. It's almost impossible because if the seller has a good product, or it's well, if you're just going to buy the assets and I'm going to get double taxed, that doesn't make any sense for me. I'll just find another buyer. So that's my viewpoint on it. But Scottie and Steve may have others.
Yeah, I think you said it perfectly. It's mostly a question to make sure you're working with, because it depends on the personal tax situation of who the seller is and any particular goals they're trying to achieve, both from a risk management and a tax perspective. So but I think Trey, you touched on all the high thematic points, but making sure you're leveraging appropriate third-party experts and advisors on that question, I think is key. That's one to not leave entirely to figuring out yourself, unless you are, I guess, in fact.
Right.
Another question we had come through, what factors should play a role in deciding to add more in-house staff or outsource the finance function entirely?
I could talk about that because we're the kings of outsourcing everything.
King of outsourcing, right?
Yeah. So I mean, we're not a normal company in that nature, and we outsource. Probably 2/3 of all of our staff across every one of our functions is outsourced, which is one of the reasons why we're very comfortable with Consero too, because we outsource a lot to Consero, and that's because we outsource everything. So that's one of the reasons why we're able to keep our profitability metrics where we are and kind of do what we can do, because we outsource so much. So we're always going to choose to outsource because it gives you so much more flexibility. But it doesn't mean that's always the right answer. I mean, not all of my staff is outsourced. In fact, my direct reports are not outsourced. They're all part of the company. So I think we have a pretty good mix of senior leadership that is part of the company and employees, and then outsource a lot of other people. But I will tell you, because we outsource so much, we really don't think about people, oh, well, they're just a contractor, they're just an employee. We don't think about it that way, at all. We use a portal called Upwork. I hate even bringing it up on this call because it's going to create more competition for me as I go try to find my next candidate. But it's a contractor portal that shows people from all over the world, and so you can get people at very good prices, but they're super smart, finance degrees, accounting degrees, some of the best universities in the world. They just happen to live in areas that you don't have to pay so much. And one of the arguments I've gotten in with some of my staff over time, or new staff that have come in saying, well, I can't give that to that person that we got from Upworks, this is really complicated stuff. And I'm like, why? And they're like, well, I mean, we only pay them $10 an hour or whatever. And I'm like, well, oh, so I guess all the hard work we really need to give to the people in California, and maybe the people in Texas shouldn't do the hard work. We're a little less expensive. And they're like, no, that's not how it is. I mean, we're just as smart as California people. I'm like, yeah, well, that's how it is, So you have to remind people about that. But anyway, so the question from our standpoint, I mean, we'd always like to outsource, and we think about those people that we're outsourcing to just like employees. I mean, the Consero person who's our controller, that really focused on all of our integrations and a lot of our month-end close stuff. We treat them just like an employee. We don't think about, well, they're a Consero, so whatever. It's not a lot of finger pointing. We're all on the same team.
Yeah, I think Trey, you highlighted a lot of the points really well in terms of, there's huge benefits to flexibility. Thinking about outsourcing, I think there is, especially as, gig economy and contract type work just continues to rise and explode, I think for very good reasons. And now, even more geographic flexibility of where you're able to get talent from a global perspective. And I think that's only accelerated, over the past year with increased virtualization of work in general. So I would agree with all those points of massive benefits of flexibility. And in many times you're not, sacrificing quality in any way. And there's a lot of workers too, who want to participate, in the economy in that way. And that may be their choice. They just don't want to necessarily be a dedicated employee to a single company. So the only thing I would add, I think you did a really nice job highlighting all the strengths and all the reasons to consider outsourcing. I think where I would say, as we think about it with certain companies, it's a couple of areas where sometimes I push back and it's, hey, maybe this is an in-house resource. One is just understanding if you've got an in-house resource, they are by definition 100% dedicated to your company. And so if you feel like there is something where it's like, I need this person to live, breathe, have zero distraction at any point 24/7 because of the particular function that they have and the way in which they're integrated with the company, that's going to give you, information, whereas they're, certainly something that's got a lot more of a tactical element to it is probably a little bit easier to consider outsourcing. Not that you can't also outsource strategy and other types of things, but really thinking about, do you need the 100% dedication of this person? How upset are you going to be if they're like, hey, look, I have 3 other clients and I need to be working on this at this particular moment? Is that going to cause a mission critical issue for this business? Like, if so, like maybe that's not, a role you're going to outsource. And the other big thematic area I would say is you need to think about the managerial structure and capabilities of the team that is in-house, because I've also seen it go the other way where there can be way heavy proliferation of contractors if people just get really comfortable because they say, oh, well, this is so cheap in this area and this, and all of a sudden you've got 50 people doing something when really, it actually would be cheaper if just one, in-house person did it. And maybe your quality of work is sacrificing because that manager just doesn't have the right infrastructure or systems or mentality or skill set in place to manage that ecosystem of consultants. So I would say we've seen certain companies where that, proliferation of contractors gets way too big, way too fast, because the cost efficacy can seem like such a no-brainer that you don't take into account how you're actually going to optimize that talent. So I think really making sure that your in-house managerial functions and controls around how you're using contractors, that's really important to make things more effective and give you that clear line of sight as to whether or not, additional outsourcing is something that's going to make sense for you. Because I do think it can get out of control very quickly from a spend perspective. Even if the per head count can look really attractive. So those are the couple of things I would add from sort of the other perspective, making sure you're pressure testing your outsourcing strategy.
Okay. Again, thanks for adding that in. Bridget, is there anything else? I know we're just past
That
our
is
1
it.
o'clock.
That's right. We're up on the
So-
hour. My big takeaway was rip off the Band-Aid early and get to the future. So we can all get to the future now. Thank you so much for your time and the very thoughtful discussion.
Yep. Steve, Scottie, Trey, thank you very much. We certainly appreciate your help today and your support. And thank you everybody else for joining.
All right, thank you.
Thank you.
Thanks for
Bye-bye.
having us. Thanks,
Bye-bye.
everyone.